So a week ago, it was 50 is 25, then it became 75 is 50, and is it 100 going to be the next 75? Where are you guys at for tomorrow?
So our call is for a 50 basis point rate hike tomorrow. We are, though, of course, flagging this potential for a 75 basis point hike. And really that comes in the backdrop of a very, very strong CPI print last Friday and signs that longer term inflation expectations are becoming unanchored.
What are the chances, Meghan, that tomorrow the Fed also signals that the chances of a soft landing have now completely disappeared?
So I think that the Fed is likely not going to signal that, but what they will need to be giving a very strong message on here is that their priority has to be getting inflation under control. I think the fact that, again, we've seen these longer term inflation expectations signaled by UMich 5 to 10 year survey really is the impetus for them to shift gears on this. Before they were kind of taking 75 out of the scope. But I think that when we see the fact that these longer term inflation expectations are really accelerating, this is the psychology in the mindset of price makers and price takers that they really need to get a handle on here.
Mm-hmm. Well, but that's kind of the thing, is that if you have the Fed swaps price at 4% terminal rate by mid-2023, to shock the market more than that, how do they do that?
Yeah, Alex, the only way that they can really do this is by signaling that they're focusing on neutral, not in nominal terms, so not in that 2 to 3% range that they've been guiding, but in real inflation-adjusted terms. That would be a meaningful shift from them and imply that they're likely going to be thinking about a terminal rate far above that 4% level when they're thinking about it in inflation-adjusted terms.
What does
Yes,
far
please.
above mean there?
Far above means that at least they need to get to around 50 basis points or so above the prevailing inflation rate to be in aggressive, restrictive territory. Again, they've been signaling this communication around neutral and nominal terms, so between 2 and 3% in terms of the Fed funds rate. But if they are thinking about this in real inflation-adjusted terms, they need to get around 50 basis points above the prevailing inflation rate, which we all know is extraordinarily high right now.
Yeah, I was going to say, isn't that like 8.5%?
Well, so, the way that they should be thinking about this is likely in terms of where those longer-term inflation expectations are. If they see those becoming ungrounded from the 2% level that they'd like to target, they need to start thinking about this in terms of where Fed funds rates are relative to those longer-term inflation expectations.
Sorry, just to nail this down. So where do you think that number is?
So again, in terms of our core view, we have terminal rate between 3.5% and 4%. But what they would do to shock the market and would cause us to rethink our baseline forecasts is, again, if they're thinking about this in real inflation-adjusted terms.
Because it would mean they'd have to get more aggressive at the end of the day.
Exactly.
But you can't make that adjustment yet because they haven't signaled being that aggressive.
Exactly.
So they don't have to hike 100 basis points for it to shock the market. They can just talk about their terminal rate in a different way.
Exactly. It's all about how they're framing it. And as we were just discussing, really the market's already forecasting and pricing 75 basis points this week, 75 basis points in July. So the shock to the market is really going to come more from where they're thinking about the terminal rate rather than what just kind of the very near term slope will be.
In terms of where, can we just talk about sort of demand destruction and ultimately whether or not the Fed is going to have to deliver that? And judging by what you said, they probably will have to. What does that do to the labor market?
Yeah, and right now that is something that the Fed has on their mind. We see this to some extent from their communication around the FOMC minutes. Right now, though, they're very much so focused on the inflation side of the mandate. And they actually do need to see a cooling in labor. They need to see a cooling in job creation to really cause this cooling in demand and cool the more cyclical components of inflation. So to some degree, taming inflationary pressures needs to come at the cost of a weaker labor market.
So part of that also is what part of the market is the Fed going to be watching? We know the Fed put in the equity market, that's dead.
Yes.
They want higher yields in the bond market, that's dead. What about the credit market? So we saw a blowout in the investment grade credit spreads. We haven't seen that in a few years now. How sensitive will they be to that? Like, I know they want to tighten financial conditions, but there's only going to be so much that they can do before they cause severe damage.
Yeah, Alex. So in our view, really, again, the Fed put is not existent right now. What the Fed is going to be very mindful of is whether or not we see market functioning deteriorate as they're tightening financial conditions here. That's something that's going to be on their radar. We haven't really gotten to the point where we're seeing that yet. That's something that we and many others on the market are very focused on and communicating with the Fed on what we're seeing. But ultimately, they need to see tighter credit conditions. They need to see a cooling in borrowing in order to, again, tame those more cyclical inflationary pressures.
Where does this leave the rest of the world, do you think? And what is the feedback loop from what's happening in the rest of the world? We've got the Bank of Japan this week, got the Bank of England this week, got a big speech coming up from, and I think we've got 14 ECB speakers over the next few days. What's the feedback loop between one and the other?
So, having been previously at the Fed myself, I can tell you that there is, a strong degree of communication across central banks. We see central banks more broadly communicating this guidance that they're going to be fighting inflationary pressures together. And I would say that message has really been reiterated across the board. The U.S. is certainly facing more of inflation stemming from demand than what we see from other regions, which puts the pressure kind of first and foremost on the Fed to lead the way and guide how the central bank policy response is going to be for this. But if the Fed can get inflation under control here in the U.S., that's obviously going to be helpful for managing inflation globally as well.